Welcome to AK Shah's Foreign Exchange Made Easy class. Today is 32nd session. Last day I have discussed strategy on overvalued and undervalued situation in future market of equity derivatives and arbitrageur gain. Today it will be continued and also start portfolio management and systematic risk and unsystematic risk to be discussed. Now come one problem of the undervaluation and overvaluation strategy. Face value of XYZ Limited is rupees 10 and market price of on April 1, 2023 is rupees 414 and spot future price after 3 months is rupees 444. Interim dividend is expected to be paid 30% on the stock after 3 months. Rate of interest is 20% per annum. So, if any arbitrage opportunity exists, if so, find out his gain. So, you already know the procedure. First of all, you find out the dividend and present value of dividend, and it will be deducted from the spot price. Then you find out the fair price after 3 months and then compare it with the spot future price and take the decision. Now come to the solution. Current spot price is rupees 414. Expected dividend 30% on the face value, that is rupees 3, which is expected to be paid after 3 months. So the present value of dividend is 3 into e to the power minus RT. Here R is equal to 20% and T is equal to 0.25 year. That is equal to 3 into e to the power minus 0.05, that is equal to rupees 2.854. Now adjusted spot price will be spot price minus dividend, that is equal to 414 minus 2.854 is equal to rupees 411.146. Next, you find out the fair price or theoretical future price after 3 months. That is equal to adjusted spot price into e to the power RT. That comes 432.238. Now you compare it with the spot future price rupees 414, and this price is higher than the fair price, so it is overvalued. Hence, arbitrage opportunity exists. The strategy will be buy spot and sell future. Now you can find out the gain of arbitrageur. First of all, you borrow rupees 414 to buy one share at the rate of 20%, and the time is 3 months, and the total amount to be repaid 414 into e to the power 0.2 r into t, that is 0.2 into 0.25, that comes rupees 435.238. Now profit, you have to find out profit. 414 is the spot future price minus the amount to be paid after 3 months of the loan amount minus rupees 3, that is dividend, that comes 11.762, that is the profit. Next come another problem. XYZ have the following information about two raw materials, AA and BB, which are used for manufacturing a product CC. Now the particulars is given for AA and BB. The raw materials, these are two raw materials. Spot price is rupees 80 per kg and rupees 90 per kg. Carrying cost 4% per annum. This is continuous compounding, and rupees 100 per quintal, that is per quintal means per 100 kg, that is rupees per kg per quarter, payable after 2 months, and 3 months future price 500 kg is the lot size is equal, this is given 40,500 and 47,200 for BB. Risk-free interest rate is 12% per annum. Advise XYZ Limited which strategy is to be taken to purchase the raw material AA and BB. Now come first AA. Raw material AA. The spot price is rupees 80 per kg. Now carrying cost is 4% per annum, continuous compounding. Time period is 3 months, that is 0.25 year. Interest rate is 12% per annum. Now theoretical future price, that is fair price, is equal to rupees 80 into e to the power r into t. Here r is the rate of interest plus carrying cost. That is 0.12 is the rate of interest, 4% is carrying cost, into t 0.25, that comes 80 into e to the power 0.04, that comes rupees 83.264. Now you find out the theoretical future price per lot. 500 kg is the per lot, is the lot size, into rupees 83.264, that comes rupees 41,632. Now the 3 months future price per lot is given rupees 40,500, and if you compare it, this future price is less than the fair price of 41,632. Here it is given spot future price 40,500 is less than the theoretical future price 41,632. The strategy will, that is, it is undervalued, and the strategy will be buy future, sell spot. This is the strategy. Next come the raw material BB. The spot price is given rupees 90 per kg. Price of 500 kg, that is the lot size, is equal to 90 into 500, that is equal to rupees 45,000 per lot. Now here storage cost is given, payable in 2 months. Storage cost per lot rupees 500 kg, that is 500 kg. It is given rupees 100 per quintal, that is rupees 1 per kg. 1 per kg into 500 kg, that is the lot size, is equal to rupees 500 per lot. The time period is 2 months. Interest rate is 12% per annum. Now present cost of storage cost. Present cost of storage cost is rupees 500 into e to the power minus RT. Point R is equal to 12% and T is equal to 2 months, 0.1667. That comes 500 into e to the power minus 0.02. That comes rupees 490.10. Now the present cost, that total cost, one is spot price and plus the present storage cost, that is equal to 45,000 is the spot price for 500, that is the lot size is 500, plus rupees 490.10, that comes rupees 45,490.10. Now you find out the theoretical price or fair price after 3 months. S into e to the power RT. Now 45,490 into e to the power RT. E to the power R is equal to 0.12 into T is equal to 0.25. That comes 45,490 into e to the power 0.03. That comes 46,873. Now you will compare it with the spot future price, which is given 47,300. If you compare it, that is future price, spot future price 47,200 is higher than the fair price, that is 46,873. Now it is overvalued. The strategy will be buy spot and sell future. Next problem. The spot price of share of a company is rupees 180. Spot future price after 6 months is rupees 200. Risk-free interest rate is 12% per annum. Is there arbitrage opportunity exist? Given spot price is rupees 180 and spot future price is rupees 200. Time period is 0.5 year, that is 6 months, and rate of interest is 12% per annum. Now fair price or theoretical future price after 6 months is equal to 180 into e to the power RT, that is equal to 180 into e to the power 0.06, that comes 191.16, which is less than spot future price of rupees 200. So it is overvalued. The arbitrage opportunity exists. The strategy will be buy spot and sell future. Now gain of arbitrager in future contract: buy a share taking a loan of rupees 180, R is equal to 12% per annum and duration is 6 months. Amount to be paid 180 into e to the power RT, that is equal to rupees 191.16. The total interest is 191.16 minus 180 is equal to 11.16. Let the spot price on expiry date is rupees 190. The lot size is 100 share. Now find out the profit on buying transaction. 190 minus 180. 190 is higher than 180, that is buying price, and selling price is 190 into 100, the lot size is equal to rupees 1000. Now profit on short future contract. Now 200 is the spot future price and 190 is the expiry future price, which is lower than the spot future price. Into 100 it will be the profit on short future contract, that is equal to rupees 1000. Now total gain will be 1000 plus 1000 is equal to 2000. Now you have to deduct from total gain the interest. 2000 is the total gain minus 11.16, that is interest per share, for that is to buy one share, into 100, that comes 2000 minus 1116. The profit will be rupees 884. Now come equity share. Risks on equity investment. Investment in equity share is much risky as there is no assurance of dividend income and capital appreciation, which is the sole objective for investor to invest in equity share. When a company issues equity securities, it is not contractually obligated to repay the amount it receives from the shareholders. It is also not contractually obligated to make periodic payments to shareholders for the use of their funds, which the investor enjoy in investing in debt securities. In debt securities, the investor will get the periodic payment and also the total payment after the on the maturity date. In equity security, the return on investment comes from dividend income, which depends on the profitability of the company and also capital appreciation, which depends on share market condition, where the investor face market risks which arise due to fluctuation in prices of equity share owing to various market related dynamics, and these factors affect all investment irrespective of their business sector. The degree of impact may be different. Market risk is measured by beta. Beta measures the stock in the form of volatility against a benchmark and is based on the principle that higher risks come with higher potential reward. Beta is greater, which is greater than 1, suggests that the stock is more volatile than the market and supposed to be riskier but provide higher return potential. Low beta stocks, which is less than 1, pose less risk with lower return. If beta is 1, it signifies that the stock has been just as volatile as the broader market. Now come capital asset pricing model. CAPM, capital asset pricing model, CAPM, is widely used method for pricing risky securities for estimating the expected returns of asset, particularly stock. It shows the expected return on security is equal to the risk-free interest plus risk premium, which is based on beta of that security. Here the equation is given, the RE, that is RE is equal to RF plus beta into RM minus RF, where RE is equal to expected return of investor. RF is risk-free interest rate referred to the investment which carries zero risk, like 3-month treasury bill, 10-year government bond. Beta is stocks beta, and RM minus RF is excess return that an investment in equity share provides over risk-free rate. That is, RM is the return on market and RF is the risk-free interest. This excess return compensate investors for taking the higher risks of investing in equity share of a company. Now, investing in equity share is a high risk investment. If an investor invests in equity share of a company, he wants some risk premium over the risk-free investment avenues such as government bond. For example, if an investor could earn a 7.5% return on a government bond, which is generally considered risk-free investment, a company share should earn 7.5% return plus additional return, that is risk premium, in order to attract the investor. If the stock gives 15% return, the equity risk premium would be 15% minus 7.5% is equal to 7.5%. There are two types of risks. One is systematic risk and other is unsystematic risk. Now start with unsystematic risk. that is specific risk. Equity is inherently riskier compared to bonds and many other asset class. Specific risk or systematic risk is a component of price risk that is unique to particular event of the company and or industry due to factors that affect the performance of business in a particular sector. Business belonging to other sector do not affected by these factors. These risks can be diversified away by investing into other share of business in different sector. Thus, the risk could be reduced to a certain extent by this method. So, to reduce the risk in the unsystematic risk pattern, the investor will diversify his investment. Now, factors of unsystematic risk. Number one is business risk. It may arise due to poor business performance caused by variety of factors like steep competition, emergence of new technology, substitute products, shift in consumer preference, inadequate supply of essential inputs, change in government policies, and also incompetent management may be taken as principal factors in the business risk. It relates where a company can make enough in sales and revenue to cover its expenses and turn a profit. Financial risk. Financial risk is concerned with high financial leverage and debt financing. High leverage leads to larger debt service problem or short-term liquidity problem due to bad debts, delayed receivables, and fall in current asset or rise in current liability. Next come default risks. Default risks refers to specifically to the risk that a borrower will default on their debt obligation and is unable to pay interest and or principal on time. Except in the case of highly risky debt instruments, investors seem to be more concerned with perceived risks of default rather than actual occurrence of default. Default risk is a subset of credit risk where a borrower will not be able to meet their payment obligations. Next come systematic risks. Systematic risks are inherent risks that exist in the stock market. Systematic risk affects the entire market or economy, while unsystematic risks specific to particular industries, sector or a company. Systematic risks can arise from factors such as inflation, recession and wars, changes in interest rates, fluctuation in currency exchange rate, natural disaster, which are beyond an investor's control and cannot be eliminated by diversification, though it can be hedged. Systematic risk is measured by beta. Types of systematic risks. Market risks. Market risks arise due to fluctuation in prices of equity shares due to various market dynamics. These factors affect all investment irrespective of their business sector. There are four primary sources of risks affect the overall market. These include interest rate risks, inflation, foreign exchange risks, and commodity risks. Interest rate risks. When the rate of interest increases, this will have an adverse effect on economic growth and also have an adverse impact on business of the country. If the rate of interest in USA increase or expected to be increased, then the flow of global capital takes place away from emerging market economy, exerting pressure on emerging market currency and also have an adverse effect on economic growth. Next come inflation. When inflation rate goes up, the rate of interest will also increase to tap it the inflation rate and try to bring down it to the target rate, leads to purchasing power risks where cost of production will increase and at the same time profit squeeze. The return expected by the investors will change due to change in real value of returns. Commodity risks. Due to geopolitical risks, which is a conflict between two countries that could significantly disrupt global trade, commodities that have a global demand, namely crude oil, are prone to price fluctuation due to political tension in some parts of globe, and this may lead to disruption in supply chain. The ongoing war between Russia and Ukraine since 24th February 2022 has given rise to greater risk exposure in capital flows, trade and commodity market in the world. Now come difference between systematic risks and unsystematic risks. Now systematic risks affect entire market or economy, and unsystematic risks, this is specific to particular industry, sector or company. Next is systematic risks cannot be eliminated by diversification, though it can be hedged with the help of index-based derivatives. Systematic risk is measured by beta, and in unsystematic risk can be reduced or eliminated through diversification. Now systematic risk arises from external factors such as market risks, which include increase of rate of interest, inflation, commodity risks and foreign exchange risks, which are beyond an investor's control. From the point of view of unsystematic risk, this arises from internal factors specific to a company or sector such as business risks, financial risks, default risks and incompetent management. Now total risk is equal to systematic risks plus unsystematic risks. Today I stop the class here. Next day the systematic risks and unsystematic risks and the problems of beta I will solve in the next class. Thank you.